Good afternoon, everyone. On behalf of Windlas Biotech Limited, we thank you for taking out time and joining us today. We welcome you to the virtual brokers and analysts meet on the announcement of company's forthcoming IPO. Before we begin, I would like to introduce the management and eminent guest who would be addressing today's gathering. From the company, we have with us Mr. Hitesh Windlas, Managing Director, Ms. Komal Gupta, Chief Financial Officer, and representing the BRLMs, we have Mr. Shirish Chiklegre, Vice President, IIFL Securities Limited, Mr. Rohan Sawant, Head Financial Sponsors Group, SBI Capital Markets Limited, Mr. Vishal Desai, Senior Vice President, ECM, DAM Capitals Advisors Limited. We have placed all microphones on mute. Post the presentation, we will welcome questions. The questions can be typed in the Q&A panel open to you, which will be read out to the management on completion of the presentation. I would now like to invite Mr. Shirish Chiklegre, Vice President, IIFL Securities Limited, to initiate the proceedings. Over to you, sir.
Thanks for that. Good evening, ladies and gentlemen. On behalf of IIFL Securities, my fellow BRLMs and Windlas Biotech Limited, let me welcome you all to this analyst and broker meet today. We are very proud to bring this exciting and unique story to the market. Let me begin by introducing the management team which is here today, starting with Mr. Hitesh Windlas, who is the Managing Director of the company. He has been spearheading the company's growth and business strategy for the past 12 years. He holds a bachelor's degree in engineering from IIT BHU, a master's degree in material science and engineering from Georgia Institute of Technology, and a master's degree in business administration from University of Chicago. After his stint as a process engineer at Intel Corporation in USA, he joined this family business in 2008. Since then, he has been instrumental in scaling up this business significantly. We also have with us Ms. Komal Gupta, who is the Chief Financial Officer of the company. She has been with the company for almost 6 years now. She's a chartered accountant and also a member of ICS and ICWL. She had significant experience in the field of finance, having worked with several organizations, including DSM, Sinochem Pharmaceuticals, Anand Automotive, and Perfect Circle India in the past. About the company, Windlas Biotech is leading player, one of the top 5 formulation CDMO players in India. Company prides itself on its research and development capability, which enabled it to be a knowledge partner and not just a contract manufacturer to its pharma clients. And as a result, company has been able to capture business from some of the top pharma companies in India. The top 7 to be specific of the top pharmaceutical companies. The likes of Cadila, Intas, Emcure, Eris, and even some of the large MNCs such as Sanofi and Pfizer. Besides the core CDMO business, company has made huge inroads into fast-growing trade generics and OTC brand business. Further, the company is also expanding into high-margin injectable formulation business going forward. And one of the use of proceeds is also, for this injectable plant. On financial front, again, company has demonstrated good growth track record with stellar operating and return metrics. In fact, despite the pandemic, company has continued its growth trajectory in FY21 as well, while improving its margins and return ratios. Before I hand over to management, let me run you through some specifics of the IPO offering. Windlas Biotech IPO is for an issue size of up to 401 crore, which is comprising of a fresh issue of 35.87 lakhs, aggregating to around 165 crores, and offer for sale up to 51.42 lakhs, aggregating to around 236 crores. The issue opens next week. Anchor book opens and closes on 3rd August, and the main book is open for subscription from 4th to 6th August. The price band for the offer is 448 to 460 rupees per share. Over to the moderator for future proceedings.
Thank you, sir. Now we will show a small corporate film of the company.
We all know, as the old proverb goes, health is wealth. At Windlas, our mantra has been exactly that for over 2 decades now. Windlas began its commercial production in Dehradun, and since the last 20 years, it has taken step-by-step approach to manufacture solid and liquid pharmaceutical dosage forms and successfully donned the mantle of one of the top 5 players in the domestic pharmaceutical formulations CDMOs in terms of revenue. We have 3 business verticals: contract development and manufacturing products and services, domestic trade generics and over-the-counter brands, and exports. In the pharma value chain, CDMOs develop new products and offer to pharma marketing companies who then launch them under their brand names. At Windlas, we drive our business with 3 different objectives: scalability, durability, and profitability. To achieve scale, one needs strong relationships with large marketers, from global MNCs, large Indian corporates to fast-growing players. Our roster includes many impressive names. We have a consistent track record of delivery, new product innovation across a manufacturing network of 4 facilities. Our trade generics vertical market products are present under our own brand names across India through our distribution network of 700 plus stockists and distributors as of March 31st, 2021. We believe in strong and transparent governance systems, and our board structure and choice of independent directors and chairman reflects this. The governance system is strengthened by internal and external audits by our customers multiple times during the year for manufacturing, quality, environment, health, and safety related practices. We served 204 CDMO customers in fiscal 2021. Our product portfolio focuses on fast-growing chronic and subchronic segments, where the treatment of choice is a multi-drug therapy involving complex development and manufacturing processing. We have delivered consistent performance during various metrics of profitability and return on capital. We are expanding into injectable dosage form as we see a high demand across all 3 verticals for such products. Windlas SBVs are growing faster than their respective market segments. Product innovation is key to our growth story. Our product pipeline is created with careful evaluation of opportunities across 3 segments. First, improving patient compliance by reducing pill burden for patients. Second, improving affordability of new drugs by launching upcoming patent expiry molecules and their combinations in our therapeutic areas of focus. And third, leveraging our patent-protected platform technologies like novel drug delivery systems to improve the efficacy, safety, or cost of an existing drug. With fast growth comes the challenge of added complexity. We have chosen digitalization as our mantra to move from a paper-based approach to an electronic-based system in manufacturing and quality controls, as well as validation activities. This enables us to undertake data analytics and track product-level information across the different facilities and teams. Our digitalization focus is key part of our efficiency initiatives. We are a profitability and cash flow focused company, and our numbers reflect this. Our overall revenue from operations increased by 30.03% from 3,288.52 million rupees in fiscal 2020 to 4,276.02 million rupees in fiscal 2021. EBITDA also increased by 60.35% from 340 million rupees in fiscal 2020 to 545.19 million rupees in fiscal 2021. Currently, Windlas operates 4 Schedule M and EHS compliant manufacturing plants in Dehradun. In total, the manufacturing facilities of Windlas had an aggregate installed operating capacity of 7,063.83 million tablets or capsules, 54.46 million pouches or sachets, and 61.08 million liquid bottles as of March 31st, 2021. Windlas is led by professional and experienced promoters and a senior management team with significant expertise in pharmaceutical industry. Taking the lead is the promoter, founder and whole-time director, Mr. Ashok Kumar Windlas, who has more than 2 decades of rich experience in the manufacturing and pharmaceutical business in India.
The overall strength of Windlas lies in being one of the leading CDMOs in India, with a focus on the chronic therapeutic category. Our best quality compliant facilities of manufacturing, robust R&D facility, along with the support of our customers, leading pharmaceutical companies in India, which is the key for us to maintain our performance financially.
Mr. Hitesh Windlas, promoter and managing director who manages the company's strategic decisions and oversees the technical and financial functions.
Windlas Biotech has made significant investments in quality management systems by moving away from paper and towards electronic systems. And we are ushering new growth by adding customers, by adding new innovative products, and growing our trade generics business across India. We are also entering the field of injectables, which is an incredibly exciting field with many new products coming up for launches and bringing growth to our company.
Mr. Manoj Kumar Windlas, promoter and joint managing director, manages the commercial operations of the company and all the product portfolio decisions. Windlas is redefining the pharmaceutical manufacturing space through its focus on innovation, quality and efficiency, all through its digitalization initiatives that make it a modern and new age company that is leading the way in transforming healthcare. Medicines revive our health through its focus on innovation, quality and affordability. Windlas aims to improve healthcare.
Thank you. Let me now invite Mr. Hitesh Windlas, Managing Director, and Ms. Komal Gupta, Chief Financial Officer, to take us through the company, its journey, and the investor presentation. Over to you, sir.
Good evening, everyone, and once again, welcome to our roadshow. Thank you for giving us this opportunity to speak about Windlas Biotech with all of you. So what I will do is speak a little bit about my background, the promoter family's background, and then spend about 4 slides giving you a top-down overview of the business. We'll delve into some of the driving factors in the industry, how Windlas is shaping up across those, and my colleague Komal will talk about our financials and the underlying reasons behind it. I am trained as an engineer, so I did my bachelor's from IIT BHU, my master's from Georgia Tech in Atlanta, and I worked as a process engineer at Intel Corporation, where we were developing next generation memory technology. So after a lot of patents and inventions, where one of our inventions in fact came as a solid state disk drive in your laptops today, it became a $2 billion business for Intel in the first year. My role was primarily technical, and as Intel was mainstreaming it, I left Intel to pursue my MBA at University of Chicago's Booth School of Business in finance, strategy, and entrepreneurship. And at the end of 2007, I moved back to India to join Windlas Biotech and have since been leading it along with my father and my brother. A little bit about the family. Windlas family has been around for more than 80 plus years and in business. And we have been running companies in US, in Europe, as well as in India, in many verticals. Until 2010, the family was together. Since 2010 onwards, after an amicable settlement, we have, my father, my brother and I, we have been leading Windlas Biotech, and this is the only company where we have our shareholdings today. So before we delve into the business, let's take a quick look at the pharmaceutical value chain. You are all very familiar that there is drug discovery, clinical trials and development, bulk drugs, formulations, packaging, and now some marketing firms are also present in this ecosystem. Windlas is active in the green colored boxes. So we do a lot of high volume formulation manufacturing and packaging. But on the basis that we do it is through our own innovation and product development under buckets number 1 and 2. So in our space, there are two kinds of business models. One is a CMO model where contract doing job work. And approval, IP around it, all in a package to a customer and saying that, would you like to launch for extending your brands? So in Windlas, we sell almost 99% of our revenue comes from CDMO. We do not sell capacity, we sell products made by us. Next slide, please. As I look at Windlas today, we do it through 3 lenses: scalability, durability, and profitability. Windlas is already a top 5 CDMO today in terms of revenue, based on our consistent and long track record of adding new product innovations to our customers, of delivering products on time, and meeting their very stringent quality standards. So we are providing our CDMO services to multinational customers like Sanofi, Pfizer, Procter & Gamble, and we are also serving large Indian corporates. So almost 7 of the top 10 pharma companies are our clients. And with this, we have a very large portfolio of existing products and technologies and formulations, which we are able to exploit both with existing customers as well as new customers. 4 manufacturing facilities and a very, very strong emphasis on quality systems. We get audited almost 40 to 50 times in a year by our customers, some of them even having permanent representatives at our sites, which we welcome. We get audited for manufacturing compliance, laboratory compliance, environment, health, safety, even compliance to labor laws. So while building this CDMO business based on the back of a innovation-led strategy, we have also been incubating a very fast-growing trade generics business. This is something that I would love to speak more about as we go in the presentation. But this is addressing the hinterland of India. And we have built this business by bypassing some of the large distributors who typically control these channels. So very excited to share our progress on this vertical as well. In terms of durability, there are some inward-looking aspects which differentiate Windlas from our peer group. And there are some outward-looking proof points. As a Tano Capital investee company, we were the first company in India in domestic CDMO sector to receive private equity funding. And since then, we have invested heavily in our organization building and process building, where our strong governance systems really differentiate us. Even today, where 78% of the company is owned by my family before listing, we have chosen to come to equity markets with a board structure where the chairman is an independent director. Mr. Vivek Dhariwal, our chairman, is a long-time pharma executive, retired from Pfizer, was on the board of Pfizer, and prior to that, on the board of Viatech Pharma. Within the team, we need always very strong motivation and incentive alignment. Almost top 100 people in the company who have discretionary decision-making abilities, whether it's a shop floor manager or a supply chain manager or a costing person, they have variable pay attached to their CTCs. This means their success depends on the company's success as well as their own contributions. We also have created an Esop pool where almost 35% of the workforce of the company, about 1,000 people in total, so 35% of that has been given loyalty options and 10% have been given performance options, again, to align and share the value created by the company with its employees. This is something that nobody in our peer group has done, and we lead the pack in our philosophy of value creation and sharing. Further, as you grow, you have learnings, you take those learnings and make them into processes. The processes become systems. But how do you institutionalize those systems? We have chosen digitalization as a key differentiator and a DNA creator for us. We are one of the most advanced companies in terms of digital softwares being implemented to make decisions. And I'm not talking about machine automation. I'm talking about using data to make the right decisions. We have ERP systems implemented not just in accounts, but also in production. Electronic quality management systems, quality control systems, Zoho-based CRM systems, integrating the knowledge and research of our front-end marketing and business development teams, along with the supply chain, R&D, and regulatory affairs team in the backend. And finally, even at my level, data analytic tools like Tableau to look at longitudinal, unit, batch level profitability data, as well as cross-sectional data across customers and therapeutic categories. We are continuously using these to differentiate ourselves and make ourselves better. And I believe this is going to be a single most important determinant about how manufacturing and efficient manufacturing stays to be our strength as we grow in complexity and size. As a B2B company, the top client share is a very important health metric. We have been continuously bringing it down, and we stand at about 11% today. In total, we are serving close to 204 accounts. And within this space also, you always have a choice. And we have chosen to work on chronic and subchronic therapies, where therapies like diabetes, neuropsychiatry, gastroenterology, and cardiovascular are the four most focused area therapies for us. These are not only the fastest growing therapies in India and the disease burden for India, but also in these lifestyle diseases, the treatment of choice is not a single molecule treatment. Physicians need multiple products to address the multi-disorder issues. And there are competencies around fixed dose combinations and complex generics, combinations of immediate release, sustained release, extended, delayed release, and various other release profiles comes into play. And we have built a very strongly concentrated business in the high end of oral solids by focusing on complex generics. This is not only harder to develop in an R&D setup, but also much harder to manufacture consistently at the right quality in high volume situations. So it becomes a moat for us. This innovation-led strategy cannot be delivered until you have a very strong and capable team as well as infrastructure in R&D, a pharma lab, a nutraceutical lab, and even an API research lab where we are developing advanced APIs in our own lab. We have a pilot plant where we can also do commercial production. So for the early launches, we are using that to make both the API as well as the formulation for our customers. And innovation velocity is what we really call as the capability to add multitude of ideas in front of our customers. That is what we are differentiated. Our material margins have been consistently around 35%. Earlier, they used to be lower. We did a course correction. Last 3 years, we have done 35% around material margins. And our ROCEs and ROEs are industry leading in our sector, as well as stable. We will, of course, speak more about our PAT margins and EBITDA margins. Let's go to the next slide, please. A little bit about the history of the company. In 2001, my father and brother ended up buying a SIC unit from UP Financial Corporation and reviving it using the professionals who used to work there. prior to the shutdown. As the tax package came to the hill states where excise holiday was declared, areas like Dehradun, Uttarakhand, Sikkim, Himachal, and Jammu became very hot destinations for manufacturing. And we also invested very significantly and expanded the footprint while adding an R&D team in those days to develop new products and rapidly launch them for our customers. We came up with products like methylcobalamin were offered first time in India by us for our customer. Products like telanelgiptin, vildagliptin, dapagliflozin, valsartan sacubitril, and many others have been launched by us for our customers on day one of patent expiry. While building this business, when I joined in 2007, late 2007, we also seeded a subsidiary called Windlas Healthcare, which started filing ANDAs and targeting the US market. We got 4 subsequent inspections that we cleared, and Zydus Cadila in 2019 came in as a joint venture partner to take 51% ownership. Unfortunately, we suffered a setback where we lost our certification due to some procedural as well as behavioral issues and are currently remediating them. But at a board level, we took the decision that for the next 3 to 5 years, we are not going to focus on US and have since been using that facility, which we bought back from Zydus, for domestic CDMO and using it for our multinational clients as well as our export markets. Next slide, please. My last slide before we jump into the business details. 3 verticals: CDMO, trade generics, and exports. What I want to point out over here is that on a global level, pharma market grows between 4.5% to 5.5%. And in India, the Indian pharma market between 9 to 11%. Our growth rate has, consistently been stronger than or faster than market. And in fact, in the last year, we have done exceptionally well. Overall, we have grown by 30% and continue to focus on finding new avenues for growth. Next slide, please. So where is all this growth coming from? The CDMO industry or the outsourcing industry is at about 20,000 crores today and expected to double in size. 2 reasons for that. Most of the large branded customers, branded generic customers, are not doing new Capex for their India businesses. Their capital allocation is going towards the higher end opportunities that they are chasing to justify their growth. Almost new product launches, which is about 3 to 4% of Indian pharma market every year, 70 to 75% of those are coming from CDMOs. So again, this is bringing more acceleration to the CDMO industry than the overall IPM. And within this space, the top few guys, which includes Windlas, have got a significantly higher market share at 21% today and expected to grow disproportionately in the future. Again, there are 2 reasons why this growth is happening at the top much faster than overall. First, as per a new regulation, marketeers have been made equally responsible for product quality. So earlier, where a branded customer would choose the cheapest guy around the block, is now when he has product liability, in partnering with the manufacturer, he's looking to work with the more sophisticated, professionalized, responsible, and well-scaled companies. Second, India has upgraded its GMP standards as new Schedule M has been notified. It is coming into effect from October. But according to this, the cost of compliance for the small companies, the very, very small guys around, has gone up. They don't have the capital, they don't have the talent, and don't even have the customer base to learn from and improve. So the cost as well as the consolidation push in the industry. Happening, Windlas has been actively working shift our identity from being a supplier to a partner. And how do we do that? We have been adding new products to our customers by deploying better R&D infrastructure, expertise and capital, quickly aggregating across customers and creating buying efficiencies, which make us the lowest cost provider in some of the formulations, and adding end-to-end services to our, for our clients. So for example, a large pharma player in India usually has close to about 100 to 130 or 40 CDMOs from whom they are sourcing for India market. Now this involves complexity, both in doing quality audits, negotiating cost plus contracts every time, and essentially managing the logistics to avoid stockouts. So when an end-to-end integrated CDMO like Windlas comes in, it is and comes in with a history of responsible behavior, high quality performance, competitive pricing, and product innovation, it becomes a natural partnership for our customers and us. And when we are able to add upcoming patent expiry molecules on day zero for our customers, it becomes a very symbiotic relationship, and we grow within the ecosystem of our customers. Next, please. So as I mentioned, Windlas has built a very strong franchise in chronic and subchronic space, along with focus on complex generics in the oral solids and liquids category for our customers. We have three growth levers. We grow when our customers do well and increase their market shares in their respective therapy or molecule. We grow when we add new customers. So our existing portfolio of almost 600 formulations, when we commercialize across new customers, becomes a growth driver for us. And when we add new products, which we are able to offer to both existing as well as new customers, that becomes a third growth lever for us. We used to run an injectable section between 2001 and 2015. That was a very small block, and building became very old. So we had taken it down several years ago. We now are coming back with injectables foray, where we are looking to add capacities in a very modern setup, which is going to be compatible with GMP expectations of the future, and target all three segments, CDMO, trade generics, as well as exports from this additional dosage form. We are looking to add lyophilized vials, prefilled syringes, and liposomal injections through our injectable entry. And about 43 crores from the objects of the issue are going to be used for finishing this facility, where the building is already ready and we are adding the machinery. Next slide, please. All the logos that you see over here are the companies who have given us their consent to use their logo or name in our DRHP. That speaks to the strength of our relationship with them. And for many of these companies, we have relationship more than a decade old with them. Responsible behavior, strong compliance, and strong track record of delivery and performance, as well as adding new products to further this growth. For a very large percentage of the products that we make, we are the sole manufacturers for our customer. That means that that customer is not sourcing that product from anywhere, including their own facility. So that is the amount of trust our customers are placing on us. And we have also been adding new customers rapidly by professionalizing our business development team and expanding our presence in front of customers. Next slide, please. I already spoke about our reduction in client concentration, where the top account concentration is that we focus on. And every year, we try to bring new customers in our top 15 or top 20 accounts so that our concentration in the top 10 also starts to stay within this regime. So long-term partnership, smart capacity allocation and capacity creation in advance, investments in R&D, which I'll speak more about, quick creation of economies across multiple customers, creating buying efficiencies and sharing with customers. That is the way in which we are building our presence and adding value to our customers' ecosystem. Next slide, please. So as I mentioned, Windlas does close to about 1 to 1.5% of revenue as R&D investment, and we are looking to gradually increase this. In our company, we bucket all R&D projects into 3 buckets. The first one is, as I mentioned, patent expiry. So, for example, we launched dapagliflozin or vildagliptin on day 0, and even their combinations. So, with metformin, with some other products, based on approvals that we get from the regulators. This bucket itself is becoming very, very rich, because upcoming patent expiries in next couple of years is a very nice and rich pipeline. And many of those products are within our pipeline, which we want to come and bring to market. The second bucket is also a very, very important bucket for our clients, where we do pill burden reduction or value-added generics for our clients. So I'll give you some examples. Older patients have difficulty swallowing pills, and they get stuck in their throat or in their alimentary canal. We come up with dispersible tablets. So now a patient can just drop it in half a glass of water and drink a nice lemon-flavored syrup. This really differentiates the brand that our customer is taking to their physician or the patient, and creates a niche for the customer in their crowded market space. And that's why they really love these kind of innovations. Similarly, we created a chocolate flavored chewable iron tablet. We did it for pregnant women to minimize their vomiting tendency when they take iron supplements. But our customer actually launched it in kidney impaired patients, those patients who can't drink a lot of water. So the chewable tablet makes a lot of sense. In these kind of things, our customer in fact took a very large and prominent brand name and created an extension of that to infuse new life into their existing brands by launching this product extension. We in fact patented this formulation. So these are the kind of value added products that we create for our customers. And finally, the third bucket is platform technology based drug delivery systems, where we are increasing bioavailability, improving safety, or reducing cost. These are more patent protected technologies, and we are looking forward to them in the future to bring us a range of products that we can launch, perhaps even in profit share partnerships with our customers. Next slide, please. Let's talk a little bit about trade generics. So as you know, there are only about 400 odd towns and cities in India which have a population of about 1 lakh or more. And in these towns and cities, there are enough doctors. So the feet on the ground medical rep model works. You send the medical reps after the doctors, they generate the prescription and the brand, and the business goes on. So this is where our customers are mostly concentrated. But there are 5.5 to 6 lakh villages or kasbas. In fact, probably close to 6.5 lakh villages and kasbas in India, where 60% of the population is living. And there the population density is much lower than 1 lakh. These are almost non-targetable by a feet on the ground branded generic model. And this is where there are not even doctors present, and the Indian government keeps talking about lack of access to quality medicines as a key problem for hinterland of India. This is the area where our trade generics vertical is targeting, and we have been building a direct to stockist model. A lot of our competitors are doing this business through large distributors. And what happens is that when you work through a large distributors, you can't see just above the retailer, that stockist, what is his credit worthiness? What other products can he sell? And what we are doing is we bypass these large distributors and build a direct to stockist model. Almost 700 plus stockists are active in our vertical. trying to cover India. In fact, in the long run, I believe we need more than 4,000 stockists to do this. But this is, not only do we save on the margin that the large distributors would have taken, but we also build a business which is reaching deeper into the country and providing quality medicines at affordable prices. Next slide, please. My last slide before we enter into the financials by Komal. So 4 facilities, almost 1,000 people on rolls, almost another 1,000 people working in contract capacity. We do close to 800 batches a month. What that means is every batch having almost 20 ingredients. So you can imagine every ingredient sourced separately, tested, approved, and then dispensed together with the rest of 20 on time. All of this is managed by a team of 3 people across 4 factories. This is the level of digitalization that Windlas has achieved, and we are transforming how efficient manufacturing will go in the future. Because when you grow, the growth comes linearly, but complexity comes geometrically. And with this kind of digitalization, we believe we are geared to win and continue to reap manufacturing efficiencies as we scale. Over to you, Komal.
Thank you, Hitesh. Good afternoon, everyone. I'm Komal Gupta. I have been with Windlas Biotech for about 6 years now. By education, I'm a chartered accountant, a company secretary, a cost accountant, and a commerce graduate. Windlas Biotech Limited, as Hitesh mentioned, is a profitability and cash flows focused company, and you'll see that our numbers reflect this. The top right chart that you see has last 3-year products revenue, and the left graph is revenue from operations. Our revenue from operations last year, FY20 versus 21, grew by about 30%. And in absolute terms, this growth was about 99 crores. This was driven by several factors, like increase in CDMO customers from 143 to 204, expansion of our business development team, increase in number of products from 1051 to 1364, increase in number of brands in our trade generics division from 128 to 185, 700 plus stockists in trade generics division, and increase in our export sales. We have consistently maintained FY19 onwards material margins above 35%, as Hitesh touched upon. In FY20, we were selling cephalosporin OSD products from our plant 3. We sold these for about 23 crores. These products became low margin, more so given the COVID situation, and it caused us an overall reduction in material margin in FY20 by about 1.8%. In FY21, after August, we have stopped selling these products. In FY20, we were also working towards getting ready for the kind of growth that we aspired. What we did is we hired our Chief Operating Officer, Mr. Shailesh Gokhale, our Central Quality Head, Mr. O.P. Sule. We expanded our business development team, started paying higher bonus to our employees, etc. In spite of these initiatives, in FY20, if we remove 7.5 crores of share of loss in Windlas Healthcare, our EBITDA margin was at 12.6%. So consistently, we have been delivering EBITDA of 12 to 13% over the last 3 years. PAT margins, as you can see, have consistently been growing. FY21 PAT included 8.3 crores of tax benefit that we received because of merger of Windlas Healthcare Facility, our former US business. Without this benefit, the profit was at 29 crores. The growth versus last year was 78%. The profit margin was at 6.7%, and thus there was a 1.8% growth in our profit margins. The working capital, we had payable days as of end of FY19 at about 110, which was on higher side. With we took a conscious decision at board level for improvement in the supply chain responsiveness that we needed to work on for the growth that we needed, and to become preferred customer for our suppliers. So by FY21 end, we are at 53 payable days. So the increase that you see in number of working capital days is because of the payable days reduction. As of FY21, our inventory days are at 55, DSOs at about 68, and payable days at about 53. Asset turnover ratio FY21 is slightly lower, but this is because of the plant 4, the Windlas Healthcare facility that we acquired in April this year, FY21. So as we increase the capacity utilization in plant 4, asset turnover as well as capacity utilization are supposed to get better. Although it is important to mention that capacity utilization in our kind of organization, the optimum utilization that we should reach is a number of 60 to 65%. So as we start nearing this kind of a number, we have to start getting additional capacities for additional revenue. The net debt of the company has consistently been reducing, and FY21 end we were almost at zero net debt. This has resulted in the kind of improvement in the ratios that you see. We get our credit rating done from ICRA. For last 5 years, almost every year, we have got either our rating improved or the outlook in the same rating profile improved. In FY21, as we acquired Windlas Healthcare, the high Capex amount that you see includes Windlas Healthcare's more than 70 crores of acquired assets. We consider ourselves a very good ROC and ROE business. The FY19 and 20 numbers that you see, capital employed and equity, include about 100 crores of Windlas Healthcare investment value, which is not there in FY21 as the merger has happened. So if we look at the business ROCs, we have consistently been delivering a 27% plus ROC in all the 3 years and ROE of about 20%. It's also important to mention that about 55 crores is the liquidity that we have on our books line as on 31st March 21. So cash and bank balances, fixed deposits and mutual funds is about 55 crores that we have.
So as Komal mentioned, Mr. Shailesh Gokhale and Mr. Om Prakash Sule, our Chief Operating Officer who joined us from Pfizer, and Mr. Sule who joined us from Mankind and Piramal, both have significant experience of running and managing injectable facilities, both from quality as well as operation standpoint. So the leadership team has been strengthened already to take care of the new foray that is being planned with the injectable section. Next slide, please. I mentioned already our chairman and independent director, Mr. Vivek Dhariwal. Mr. Srinivas Venkatraman is a founder of MyCFO. They have helped several small and medium companies improve ROIs through their consulting practice, and he's an industry leader in his own right. Mr. Gaurav Gulati is an entrepreneur turned investor and manages ScaleX Partners with investments in the new economy. Next slide, please. So to summarize, we have built a strong, resilient, fast-growing top line as well as a bottom line, healthy bottom line growth business in oral solids and liquids. Our intent is to increase our customer base, develop new products more rapidly, and also grow our trade generics vertical, which is almost an independent opportunity in terms of the vastness of this opportunity for us. We want to add injectables. This injectable is again not focused on any regulated market. It will serve our CDMO business in India, where we will again not sell capacity but actual sell products made by us. Our trade generics vertical, where we target institutional accounts and hospitals, and our exports business, where some of the ROW markets where we are active already in are very, very lucrative markets because they have almost zero development of manufacturing of products like lyophilized vials and liposomal injections and such. So this injectable foray is going to add to our all three verticals. Also, we mentioned in our DRHP and RHP that we want to be an active consolidator in this space and will be evaluating different kinds of opportunities to grow inorganically as well. Thank you. I will be happy to take questions now.
Thank you, sir. We will now open the floor for Q&A session. We have already received some questions. While we will take those questions first, we would request everyone to post their respective questions in the Q&A panel. We'll try our best to ensure that all questions are answered. The first question: what is the implied market cap at the upper end of the price band post IPO?
Our market cap at the upper end is about 1,003 crores, close to that.
Okay. You have shown an exceptional gain of rupees 49.5 crores gain on losing control in subsidiary. Can you explain?
Sure. So the gain that we have shown in FY19 is the gain relating to the Cadila acquisition. So 51% stake which Cadila had bought. So this is the difference between net asset value of the company before the stake sale versus the after stake sale. So we had about 52 crores of net assets for the 49%, the value of the healthcare company, and the net assets after the acquisition, which was about 102 crores because of 155.55 crores that Cadila had invested in the company. So this is the difference between 52 crores NAV before and after the acquisition. This is the difference which has been booked as a gain.
Can you give comparative average margin figures vis-a-vis a pharma company which is selling under its own brand?
So this varies across the large pharma players. If you look at companies who are at the top end, the largest few, the material margins for them, gross margins for them would be in the range of 80%, 80-82%. But on an average, close to about 65 to 80% is the margin for marketeers, because of course they are also bearing lot of costs in sales and marketing, teams. And some of the large companies have almost 15,000 employees in their sales and marketing teams, and so on and so forth. That is where the differences are in the material margins.
Okay. If the EBITDA margins are as good as 35%, why is the PAT margin so low at 8.7%? Also, why is the growth so patchy before FY 2020-21?
Our EBITDA margins are in the range of 12 to 13% actually. And so our net margins are not far from that. So we have about 7% of net profit and about 13% of EBITDA in FY21. The difference obviously is because of the depreciation, interest and tax.
Does the company do CDMO primarily for domestic markets? And what kind of revenue stream does the business generate? Is it largely on cost plus basis, or there is some other element as well?
Yes, our business is primarily in the domestic market. And it is almost, as I mentioned, 85% of our total top line. And our contracts are usually different based on different customers and different products. And these are all almost always cost plus contracts. So the API cost plus excipients and other materials, analytical cost, yield, adjustment, and processing costs related to the complexity and the time taken in production for each product. So, and beyond that, our overheads. So it's a very complicated cost sheet and individually negotiated for every single product and SKU for every single customer.
Why is there difference in ROCE shown in presentation, that is 27.5%, wherein this is reported 20.23% in DRHP?
So as you can see, we have mentioned that we have about 55 crores of liquidity that we have as on FY21, while mentioning in RHP that the capital employed has not been adjusted for that, which we have done here and also mentioned as a footnote in the presentation.
If you adjust for the acquisition of the group company in 2020, what is the organic growth rate in FY21?
So FY20 numbers anyway don't include any, FY20 numbers don't include healthcare numbers. So if we look at separate FY21 numbers, excluding Windlas Healthcare, we have a growth in revenue of about 25%. EBITDA has grown by more than 60%, and PAT has grown by about 85%.
Why is your capacity utilization 39% is too low compared to Akim's drugs? And also why your cost of goods sold are so high? Is it sustainable?
So as we mentioned, capacity utilization, we have recently acquired plant 4, the Windlas Healthcare facility, in which the capacity utilization is yet to grow. That is one. And also we have repurposed our plant 3, which earlier we used to use for cephalosporin OSD. Now we are going to use it for the regular drugs. So the capacity utilization percent is supposed to grow, not beyond 60-65%, but it will surely grow as we increase the sales.
Also, just to add to that, Mr. Sudhir, the cost of goods, when you compare with others, you also have to adjust for their own branded generic business and their own exports business, as well as their own API business, as well as their own pharmacy chain business. So my sense is that if you were to look at CDMO, while these numbers are not readily available, we would actually be on the higher side in terms of material margins, and our ROC numbers actually reflect that.
As per RSP, 20 crores of IPO proceeds are used for repaying debt. Let us know what's the purpose of 20 crores debt raised from Bajaj Finance, where it's utilized.
Bajaj Finance loan was taken for general corporate purposes. So it has been utilized to make payment of expenses and for payment of vendors, etc.
Why is the R&D spend coming down from 42 million in FY19 to 36 million in FY21?
The primary reason for this is that, unfortunately due to COVID, the clinical trials and bioequivalent studies have, not been happening because patients are not, actually nobody is going to the hospitals unless absolutely necessary. So we expect that it will pick up once, these COVID and vaccination things got resolved.
Even though we have stockist model against other peers having distributor models, why our EBITDA margin are lower compared to peer in generic business?
So we have not actually specified EBITDA margins for different businesses. We have provided, revenue split only. And in fact, our margins on a material margin level for both our export vertical as well as our trade generics vertical are better than our CDMO vertical.
Why is the PE investor making complete exit? Is no growth expected in future?
Nano Capital's Fund 2 has reached end of life. In fact, last year, they were supposed to return the entire capital to their investors and are on extended time. So they have to exit for sure. It is a contractual arrangement between them and their LPs. It is not about the opportunity for growth. We are definitely very bullish that we should be able to take the company to new heights going forward.
Working capital has increased significantly. What is the rationale for it and how this will be moving in coming years?
So as I mentioned, the working capital is increased because of reduction in the payable days. So we were on higher side of it in the range of about 110 days. And now we are at 53 kind of a range in terms of payable days. The working capital days are expected to remain in the range of 70 to 4-5 days here and there. So basically it is the same range that we expect to continue in the coming 2-3 years.
What is the growth rate for the company? Sorry. Yeah. What is the growth rate for the company in FY21 if you adjust for the group company acquired in 2020? What is the last 5 years sales CAGR adjusted for acquisitions?
So our FY21, as I mentioned, we have 25% of growth on standalone Windlas Biotech if we exclude Windlas Healthcare sales. And last 5-year sales CAGR in terms of revenue has been a bit low in terms of about likes of 9 to 10%. But our profits have been much higher than that. So about 25% EBITDA growth CAGR. And if we remove the exceptional items, the PAT CAGR has been more than 50%.
Okay. The company has long-term contracts with the customers. What is the compensation in case the demanded volume by the customer is lower than the contracted volume, or there is an early withdrawal of contract?
So, this kind of take-or-pay contracts don't exist in the Indian CDMO sector. They are more in the export sector. And so we do not have, very rare, I think probably only in one contract do we have a take-or-pay. But most of the time, we are not looking for exclusivity or not locking up volume for the customer. But we know that since we are the sole suppliers for that brand, then all of the volume will be coming to us. At the same time, we are not providing any exclusivity. That if the if that we cannot cater to any other customer or must reserve the capacities for that customer. So the contract is balanced mutually in this manner.
Okay. How many plants are US FDA approved, and what is the possibilities of getting US FDA clearance for the plant 4?
We had only one facility, plant 4 now, which was approved by US FDA 4 times before the import alert. And we are finishing the remediation that we had committed, even though we are not chasing the US business. We are finishing that remediation by December of this year. We expect to give our final submission to FDA. And while the ANDAs have been written off, and we are not chasing this US business, we expect that post our final submission, FDA will come and look at the compliances again before they clear.
The company derives 87% of the business from CDMO services. Are these from the manufacturing of the branded generics for major pharma marketers?
That is correct. 85% of our business is in CDMO products and services. We hardly do any services because we are selling products which are developed by us. And these are as we mentioned, almost 58% of the revenue is coming from the top 10 accounts, which are the larger accounts in India as well.
Has the company participated in the government PLI scheme?
So for the formulations, the scheme is still open. The PLI one was for APIs only. And yes, we are planning to apply.
What is the margin differential between formulation CDMO, trade generic, and OTC brands?
So
we have not provided this. Komal, go ahead, please.
Sure, Hitesh. So I was just saying that we don't track the margins separately for all these 3 divisions, since we supply to all the 3 divisions from same facilities, same plants. We look at the material margin differences, which for sure for trade generics and OTC brands and also exports are better than the CDMO business.
The company is planning to venture into injectable CDMO. What are the margins in that segment?
Injectables margins are much, much higher than the regular OSD business. The EBITDA margins are better. The asset turnovers are lower in injectables business, but the EBITDA margins are much higher.
What will be the holding of sponsors and promoters' stake in post-IPO?
So as you know that we are hardly doing much of OFS. My mother is selling some parts of her holding. So promoters are expected. We will expect to have almost 60% of the company post IPO as well.
We'll take a couple of last questions. Who are the main raw material suppliers of your core business?
So we have lots of companies that we do purchases from. excipient suppliers, API suppliers, the largest contributor in our supplier concentration is about 2.1%. We have been very mindful of making sure that our customer concentration as well as supplier concentration are monitored in a very healthy manner. So this is something that we have kept track of, and that's the largest one.
What is our overall CDMO market share in India, and where do you see the share in next 3 to 4 years?
As I mentioned, the 20,000 crore market estimate is for overall outsourcing. That includes both CMO as well as CDMO. And a lot of companies have mixed models. We are almost purely CDMO, where others are mix of both, and others are pure CMO. So there is no sort of a authoritative database out there. I believe that if you just look at it on a total outsourcing market, then you divide our revenue by our CDMO revenue by 20,000 crores to get the share.
Last question. What is the Capex plan over the next 3 years, and what is the company dividend policy?
Do you want to take that, Komal, and I'll take the dividend policy thereafter.
Sure. So the Capex, as we already mentioned, we have about 50 crores of injectables division where we plan to do the Capex, about 7 crores in our plant 4. And rest, we have about 10 to 15 crores of annual maintenance Capex that we spend. So in terms of coming 3 years in total, we expect to spend about 125 crores in Capex.
Great.
Thank you.
With respect to the dividend policy, that question, we are in the discussion with our board to come up with, and our shareholders, so which will change once our current shareholder exits. We will be coming up with a dividend policy where we will be providing some sort of a range-based policy. And the idea is that as our ROCs are much higher than our growth, we will be able to share with shareholders some dividends, and we just need to set that right into a formula and announce, in which we'll be doing post the IPO.
Thank you so much, sir. Concluding this conference, let me invite Mr. Rohan Sawant, Head Financial Sponsor Group, SBI Capital Markets Limited, to give the vote of thanks.
Thanks a lot. I do hope everybody can hear me. First of all, thanks a lot, Hitesh and Komal, for that fantastic presentation. Really appreciate. I do thank everybody on the call for their time. I do hope most of your queries are answered. Just in case some are left, please do feel free to write into us. I think before I let all of you go, just a couple of pointers. This IPO is going to be open from August 4 to August 7. It's a around 400 crores IPO. But I think one point that I wanted to point out is that we have taken a 144A license for this, which means that we have actually gone across to the US geographies to market this company. That is the kind of confidence that all the bankers had with respect to really the quality of the management and quality of the business build. Each one of us on the trade do believe that I think Indian pharmaceutical industry is, this is the Goldilocks moment for the Indian pharmaceutical industry. And I think more so for the CDMO. And I think Windlas, the way company is built out and the way company is getting built out with future strategies, I think there is a massive amount of opportunity with respect to consolidation out there. I think Hitesh's and the team's razor-sharp focus on products, on quality, on Komal's focus on financials, I think it will hopefully go a long way in creating massive amount of value for the incoming equity shareholders. And with that, we'll look forward to support of each one of you. And thanks a lot for your time again.
Thank you, sir.
Thank you. Thank you very much.
Thank you.
Thank you, everyone,
so much
for joining the virtual brokers and analysts meet of Windlas Biotech Limited for their forthcoming IPO. Please feel free to reach out to us for any further queries or email us at ipo@adfactorspr.com. We will do our best to revert to your queries within 48 hours. Take care and stay safe. Thank you, everybody.
Thank you.
Thank you.